Good morning. Let's continue our discussion on computing income from business. So, in the preceding classes, I uh, had discussed a couple of concepts which primarily revolved around a question. Since profit and loss account is already prepared by the sole proprietor, and the objective of preparing profit and loss account is to come to a conclusion whether the organization has developed, whether the organization has delivered profits or not. So net profit is already there in the profit and loss account. So what is that we are supposed to do when business profit is already given in profit and loss account? Then what is we are supposed to do? So the answer is the profit and loss account which is prepared and the net profit which is shown in profit and loss account cannot be considered for taxable purpose. For taxation purpose, that profit cannot be considered for a simple reason that there are incompatibility issues. Reason number one, there is incompatibility between accounting rules and the income tax rules. Reason number two, the items shown in the profit and loss account, some of the items of both debit as well as credit is not allowed by income tax department. Reason number three, profit and loss account has many items which are not related to business. On account of these three reasons, we have to prepare a reconciliated statement, also known as income from business. So the purpose of preparing this reconciliated statement, what you see on your screen, is called statement of income from business. And the last step of this statement is called taxable income from business. So this amount which is identified here at the end of these three steps is the amount which is subject to taxation. So your job is to prepare this reconciliated statement. Now, in order to prepare this reconciliated statement, what is your data source? Your data source is the profit and loss account. So first step is to look at the profit and loss account and figure out what is the net profit or loss. So don't get confused, because I see at times there is a net loss. So should you take net loss here or only net profit? The answer is anything. Whether it is net profit or net loss, identify from profit and loss account and record this here. So first step is to record the net profit or loss given in the P&L account. Second step. Second step is to add all those transactions that reduces net profit. And I've already given you the reasons yesterday. Why would somebody increase the net profit and why would somebody decrease the net profit? Why do people decrease deliberately? Why do people decrease net profit? The answer is quite simple, that nobody wants to pay tax. People want to escape from tax. And as a result of this, they join hands with chartered accountants who would indeed help them and give them numerous excuses of escaping from the ambit of tax laws. And therefore, chartered accountants help assessees to eliminate the tax burden itself by giving them various means, loopholes of the taxation laws. So why would somebody wants to show lesser profits? Answer is simple, because they don't want to pay tax or they want to pay lesser tax. So what would they do is they would indulge in those transactions which are not permissible. So therefore what we should do is we should add back such transactions, add back all those transactions that reduces net profit. That is our step number two. Step number three is deduct all those transactions that increases the net profit. So the entire table has only three steps. Take the net profit, add those transactions that reduces the net profit. Step number three, deduct all those transactions that increases the net profit. Now, once you're done with these three steps, you get the final answer, which is income from business. And this is what you're supposed to do. This is how you're supposed to prepare this statement, right? But it seems simple, but it's not as simple as it sounds or it looks, because there are a lot of things which you people have to understand, right? So let's focus on step number two, which says add transactions that reduces net profit. So here, the first item under this heading is inadmissible expenses. So what you people have to do is You people have to understand what do you mean by inadmissible expenses and what do you mean by inadmissible incomes. What do you mean by admissible expenses and what do you mean by admissible incomes? Four things you have to understand. So let me list it out. First, you have to understand what do you mean by inadmissible incomes. Then what do you mean by inadmissible? What do you mean by inadmissible expenses? And what do you mean by inadmissible incomes? Okay. Once you're done with this, third, you have to figure out what do you mean by admissible expenses and what do you mean by admissible incomes. The word admissible means allowed and the word inadmissible means not allowed. So when we say inadmissible expense, what do you mean by inadmissible expense? Inadmissible expense are those expenses which are not related to business. So what do you mean by inadmissible expenses? All those expenses which are not related to business, plus not allowed, not allowed by IT department, income tax department. So that's the meaning of inadmissible expense. They are non-business expenses and they are expressly disallowed, or in other words, not allowed by income tax department, for which you guys have to study section 30 to 43T. To figure out what is admissible and what is inadmissible, you have to study section 30 to 44D. And to make it a little more simpler for you guys, as I mentioned in the previous class, first apply your common sense, then let's go for income tax provisions. Right? So identifying non-business expenses from profit and loss account, it's not that difficult. It's very easy. Right? This is the statement what I had shown you in one of the classes, in one of the preceding classes. Right? And you see household expense. What is this? It's a non-business expense. Since it's a non-business expense, therefore it is inadmissible expense. Right? Similarly, donation. Donation has nothing to do with business. So it's a non-business expense. In other words, it is an inadmissible expense. Right? Drawings, again, non-business, or in other words, it's a personal expense. So therefore it becomes inadmissible expense. Right? So what is your job? Your job is to identify inadmissible expenses. Right? And that's one thing. Second, you should also know, where do I locate inadmissible expenses? Where do I find them? Two things, if you learn, things will become quite easier for you when we do numerical problems. First, what do you mean by inadmissible expense? Second, where do I find it? So where should you find this? Where do you find inadmissible expenses? The answer is debit side of P&L account. So where do you find it? On the debit side of P&L account. Now, what is opposite of inadmissible expenses? Opposite of inadmissible expenses is admissible expenses. It means what? These are business related expense, and then it is also allowed by IT Act. Now, where do you find this? Where do you find admissible expenses? And what do you mean by admissible expenses? Admissible expenses are those expenses which are related to business, which is allowed by income tax department, but this is the statement which makes difference. Not recorded in P&L account. That means, let's see the P&L account. Inadmissible expenses means they are non-business and not allowed by income tax department, but recorded in P&L account. So we know that it's available here. But what are admissible expenses? They are business related expense. They are allowed by income tax department, but assessee has forgotten them to record. It's not there in profit and loss account. So if it is not there in profit and loss account, where will I find admissible expenses? Where will I find this? You have to find this in adjustments. So don't get confused saying that, okay, sir, household expense means inadmissible expense, but salary is admissible expense, right? Salary is admissible expense, you're right, but it is already recorded now. What we want is admissible expense, which is not recorded in P&L account. So that's the reason I said the definition of admissible expense for our purpose, is expenses which are allowed by income tax department, expenses which are related to business but not recorded in profit and loss account. So if it is not recorded in profit and loss account, we have to find them in the adjustment, right? So that's all about your admissible expenses and inadmissible expenses. Now apply the same rule for inadmissible incomes. What are inadmissible income? These are non-business incomes. And these are incomes which are not allowed by which are not allowed by income tax department. So where do you find them? On the credit side of P&L account. So what's the definition of inadmissible expense? Inadmissible incomes are those incomes which are not related to business. They are not related to business. Plus not allowed by IT department. Not allowed by income tax department. But recorded in credit side of P&L account or credited to P&L account. So in this list, which are the non-business expense? We had a discussion on that. Dividend, non-business income, so therefore it is inadmissible. Rent from house property, inadmissible income because it is not related to business. Interest on government securities, inadmissible because it is not related to business. Profit from sale of machine, inadmissible income because it is not related to business. I told you in one of the classes that what do you mean by business income? What do you mean by business income? The answer to this question is business incomes comes from sales plus activities related to sales. So always keep this formula in your mind. Anything which is not related to sales is not a business income. Any income which is not getting generated from the activities related to sale is also not business income, right? Now, what are the examples of activities related to sales? Examples are commission received from wholesaler, brokerage received from supplier, discount received from wholesaler, export incentive received from government. All these are examples of activities related to sales, right? So you have to remember the definition of, the concept of business income. So remember this equation. Business income is nothing but sales plus activities related to sales. In addition to this, whether you like it or not, you have to also remember the incomes mentioned in section 28. So this constitutes business income, right? So what is your job? Your job is simple. The moment you see profit and loss account, first record the net profit. Second, add all those transactions that reduces net profit. So what are the transactions that reduces net profit? First is inadmissible expenses. What do you mean by this? These are expenses which are not related to business, not allowed by income tax department, but they are debited to profit and loss account. So where should we locate them? We should locate them on the debit side of profit and loss account. Next, what do you mean by admissible incomes? Admissible incomes are those incomes which are related to business, which are allowed by income tax department, but unfortunately it is not recorded in the profit and loss account. If it is not recorded in the profit and loss account, where should we find them? We should find them in the adjustments. Same rule applies here also. We have to find this in the adjustment. So this is your job. So let's keep this aside. You don't worry about this because when we do problems, again, we will discuss this format. Right now, you focus on understanding what are the list of admissible and inadmissible items as per IT Act. So I told you first use your logic, use your common sense, then also remember the IT provisions. So this is the first point which we had discussed on in the last class, that any expense when we are evaluating whether we should take this as a business expense or not, apply these four important criterias. Criteria number one, in order to consider an expense for deduction from profit and loss account, check whether that expense is a capital receipt or not. If it is a capital receipt, it is not allowed because capital receipts are recorded in the balance sheet. Point number two, it should be a business related expense. It should not be a personal expense. In other words, it should not be a non-business expense. Third, expense is allowed only if it is paid. Outstanding expenses are not allowed. Point number 4, reserves and provisions are inadmissible as per IT Act. And the reason I told you, the more reserves, the more provisions you create, it will eat away your profits. Imagine my gross profit is 10 lakhs, right? But what I've done is minus reserve for bad debts, 5 lakhs, minus provision for tax, 5 lakhs. What will be my net profit? 0. So what will be my tax? 0. So therefore income tax department is saying, boss, you can't claim reserves and provisions. So therefore reserves and provisions are inadmissible. But there is one uh, clause, and the clause says that, okay, you have created a reserve of 5 lakhs for bad debts, right? In that, what is the actual bad debt? Let's say in this 5 lakhs, which we are doubtful whether we will receive or not, actually what has happened is only 2 lakh rupees worth of loss we have incurred. Only from certain customers, right, who are 100% sure, who are not at all will pay because they are not there in their location. They have eloped somewhere, right? I have given goods to different people in different parts of Bangalore. Now I'm going for collection. But these two guys who are supposed to pay me 2 lakhs, they have shut their shop, they have closed their business, they have ran away somewhere. So what will happen in that year? 100% bad debt is this 2 lakh rupees. So what I do is from this 5 lakh minus 2 lakhs and the remaining 3 lakhs, which is considered as reserve for bad debts, will be inadmissible. Similarly, let's say I have created a provision to pay tax for the next 5 years. How much provision I have created? 5 lakhs. But what is the actual tax paid in the current year? 1. Let's assume it's 1 lakh. So that means remaining 4 lakh will become inadmissible expense. So that's the reason this sentence says, however, if a portion of reserve or provision is utilized, the amount utilized is admissible. So what remains unutilized continues to remain an inadmissible expense. So these are the first 4 important rules which you people have to remember to decide whether to consider an expense as admissible expense or inadmissible expense. So this is very important. So now let's discuss some of the other provisions. So this is the first point. General rules for deducting an expense. Now let's move to point number 2 and the other points. Second point is capital expenditure, which we have discussed. Capital expenditure is a balance sheet item. It should never be recorded in the balance sheet. But what happens is for capital expenditure, you are entitled for depreciation. For example, let's say uh, in my profit and loss account, on the debit side, right, I have put an item as 2 machinery purchased. How can you record to machinery purchase? Machinery is a revenue, machinery is a capital expenditure, but profit and loss account is a revenue and expense account. So you can't record capital receipt in profit and loss account. So this should go to balance sheet. But in case if the assessee has already recorded this, if assessee has already recorded this, what will you do? You will consider this as inadmissible expense and you will add this to net profit. Remember, what is the second step? First step is to write down the net profit. What is the second step? Add all those transactions that reduces net profit. So this machine which this guy had recorded was unnecessarily reducing our net profit. So therefore, while finding the solution, we have to add this back to the net profit. As simple as that, right? So this will go to the balance sheet. Now, you cannot claim capital expenditure, but what you can do is you can claim depreciation. Depreciation is classified as a revenue expenditure. So can I claim? I cannot claim to machinery. I cannot claim this machinery purchase, but can I claim depreciation on machinery? The answer is yes. You can claim depreciation on machinery. It's allowed, permitted, right? But fine, I'm charging depreciation. Let's say the value of machinery what I bought is 1 lakh rupees. Right now, you know that in order to claim depreciation, you need to have a rate, right? Or shall we follow this? What you guys generally follow in accounts? Depreciation is equal to life of asset divided by not life of asset. Depreciation is equal to value of asset. Value of asset divided by life. So let's say we have purchased a machinery of 1 lakh rupees. That's the value or cost of the asset divided by life. Let's say this machinery has 5 years life. So shall we charge 20,000 depreciation per month? Is this how we calculate depreciation? Generally, this is what we do in accounts. But from the perspective of income tax, you should not do this. This is not allowed at all. Because in order to claim depreciation, there are certain conditions which are mentioned in section 32. Section 32 is a separate chapter for all those guys who are studying corporate taxation. Your first chapter is depreciation. You will study depreciation as one chapter. That means you will go in and out of depreciation. But for the others who are studying income tax, we don't go in depth, but we discuss only those aspects which would help us to solve the problem. So what are those aspects? What are these conditions? So in order to claim condition, point number one, the assessee should be the owner. The assessee should be the owner of the asset. If the assessee is not owner of the asset, he cannot claim depreciation. And that's one of the reasons when you buy the machine on leasing and hire and purchase, you cannot claim depreciation, because when you lease an asset, when you hire purchase an asset, the ownership is not on your name. The ownership is on the name of the company which owns the asset and which has given the asset to you for usage, right? So you can't claim depreciation. So that's one of the important conditions. To claim depreciation, assessee should be the owner of the asset. Point number two, you have studied different methods of depreciation in your second PUC. There was a chapter called depreciation. From the accounting perspective, there are so many methods: straight line method, diminishing value method, annuity method. In income tax, only one method of depreciation is allowed, and that is written down value method of depreciation. So in order to claim depreciation, the first condition is ownership. Assessee should be the owner. Second, which method of depreciation should we follow? We should follow only written down value method of depreciation. Now you guys know what is written down value method of depreciation. In order to calculate written down value method of depreciation, you need to have rate of depreciation, and this rate of depreciation is mentioned under section 32. So section 32 tells us what is the rate of depreciation for different categories of asset. So this is the second condition. Remember, third condition is that we cannot claim depreciation on individual assets, but we should claim depreciation on block of assets. And this is one of the very widely asked questions in the examination for 2 marks. Define block of assets. So you pay your attention here and try to understand what do you mean by block of assets. Now what income tax department says is you don't have to charge depreciation on each and every asset what you have in the business. For let's say I have a shop in Avenue Road and I have a bookstore. Okay. So in my bookstore, I have AC, I have fans, I have furniture, and I have some machines also, which I've kept for various purpose. These are my shop itself. My shop itself is also an asset, right? Which is nothing. Shop is nothing but your building. These are my assets, right? And I also have a car which I'm using for delivery. So any customer who buys something, this car is used for delivery. So these are some of the assets what I'm using. Now, generally what we do in accounting is separate depreciation on cars, separate on AC, separate on fans, separate on furniture, machine shops, separate depreciation ledgers we prepare and we charge depreciation. But what income tax department says is that you cannot charge depreciation on individual assets. Rather, you charge depreciation on block of assets. Now, what do you mean by block of assets? Block of assets is a process in which we classify assets into one category based on the same rate of depreciation and the asset class. Block of assets is a process of classifying assets into one block based on the asset class and the rate of depreciation. For example, car rate of depreciation as per Income Tax Act is 15%. Machinery, the rate of depreciation as per Income Tax Act is 15%. Building rate of depreciation as per section 32 of Income Tax Act is 10%. Furniture, the rate of depreciation is 10%, right? Fan or fittings, again 10%. AC, which is considered as a machine, 15%. So what I should do is, instead of charging depreciation on each and every asset, let me classify all those assets which comes under 15% category, 10% category. Let's total what is their WDV, what is their written down value. So as on 1st April 2000 of previous year, let's use the word previous year, what is the value of car? Let's say the value of car is 2 lakhs. The value of AC is only 20,000, right? The value of machine is 80,000. So 2 lakhs, 2 lakh 80,000 plus 20,000, 3 lakhs. So what will be the WDV of machine? 3 lakhs. So on this 3 lakhs, I will charge 15%, and whatever the amount of depreciation is, I will record it in the profit and loss account. So this is how we charge depreciation in Income Tax Act. We charge depreciation based on certain conditions which are laid down under section 52. So what is the first condition? First condition that if the assessee wants to claim depreciation, assessee should be the owner of the asset. Second, only written down value method of depreciation is allowed, but there is some exception here which we don't have to discuss because anyways we are not going to work out the exception case. But if you want, I'll just mention it. Only exception is that companies who are into power generation business, companies who generate power and who supply power, has the option of going for straight line method. For example, Bescom. What Bescom does, it's a power distribution company in Bangalore. So Bescom can follow straight line method. So only power generation companies are given exceptions. Otherwise, by default, everybody should follow written down value method of depreciation. Point number 3, depreciation is not charged on individual assets, but they are rather charged on block of assets. Right? I hope you guys are clear about some of the important provisions related to depreciation. Now, the final and the last important point which you should remember pertaining to depreciation is that in case if the asset is bought in the previous year, if the asset is purchased in the previous year, and if it is put to use for less than 180 days, then we charge half depreciation. But if the asset is purchased in the previous year, and if it is put to use for more than 180 days, then we charge full depreciation. So sometimes you have to watch out for the dates, which are extremely important. Right now, let me give you a small example here. Let's go to our profit and loss account. Assume here, let's say this item. Instead of this, let's say there's an item here which says AC purchased. Okay, AC purchased. So what will happen now for this AC purchased? The answer is AC is an asset, so it should go to balance sheet. So therefore this becomes inadmissible expenses. It becomes inadmissible expense. Fine. So, but can the assessee claim depreciation on the AC? The answer is yes. The assessee can claim depreciation on the AC, but this amount 15,000 becomes inadmissible. So sometimes you have to read it properly and find out if there is any capital expenditure or if there is any asset purchase recorded. If the asset purchase is recorded, then it becomes inadmissible. Now, very important, very important. Let's say in the brackets, date is given, purchased on 1st July 2019. Date is given. So let's say our previous year is 1st April 2019 and it ends on 31st March 2020. Okay, but the asset is bought on which date? 1st July 19. So from 1st July 19, which is nothing but the date of purchase. This is date of purchase to end of previous year. Previous year ends on 31st March 2020. How many days are there? Is this more than 180 or is this less than 180? The answer is obviously more than 180 days. So can the assessee claim full depreciation? The answer is yes, he can claim. But if the asset is purchased for less than 180 days, then the assessee can claim only half depreciation. So sometimes date will be given. That is where you have to be extra cautious to figure out whether half depreciation is allowed, whether full depreciation is allowed, right? So that is where you people have to be a little more cautious. And I always try to figure out what are the ways through which I can ensure that my students remember these concepts. So as far as this 180 days concept is concerned, if you don't want to technically count, otherwise you have to count, right? In our example, it was July 1st, July. That means 31 days in July, September 30 days, October 31 days, which becomes a hectic task for you guys to count then, right? Instead of this remembering and totaling the days, just remember Gandhi Jayanti. Gandhi Jayanti, 2nd October. If the asset is purchased after Gandhi Jayanti, it is less than 180 days. If the asset is purchased on or before Gandhi Jayanti, it is more than 180 days, right? So that's the trick for you guys to remember how to figure out more than 180 days or less than 180 days. So these are some of the important provisions pertaining to charging of depreciation, right? Now, there are some more important things which you guys have to remember pertaining to depreciation. This depreciation is not that easy. It has some, uh, I would say, critical elements, right? Now, what is that you have to do? What is that you have to remember? Let me tell you what is that you have to do. Well, let's say this is our profit and loss account. Okay, this is our profit and loss account. Debit side, credit side. Depreciation amount is given. Depreciation 20,000. How will you come to know whether this depreciation is as per IT Act and as per the provisions of Section 32? How will you come to know whether the assessee has followed all the conditions or not? I told you the condition. Condition number one, the assessee should own the asset. The assessee should follow a written down value method. The assessee should use the rate of depreciation as prescribed by the income tax. He cannot use his own choice of depreciation rates. All those conditions should be followed. How will you come to know whether it is as per 32 or not as per 32? The answer is look at the adjustments. Let's say the adjustment says like this. First adjustment is depreciation as per IT rules is 44,000. Like this, it is given in the adjustment. So if the adjustment is saying 44,000 is right depreciation, which is as per IT rules, then what is this 20,000? This, which means if as per IT rules it is 44,000, that means this 20,000 which is recorded in profit and loss account is not as per IT rules. Therefore, this becomes inadmissible expense. Simple. This is your first situation. Situation number one. What is situation number one? Depreciation is given in profit and loss account also, in adjustment also, but adjustment depreciation is correct. In that case, what will happen? The profit and loss account depreciation will be considered as inadmissible. First situation. Second situation. Nothing is given in the adjustment. No mention. Nothing is given. Only this is given. In that case, in second situation, no adjustment is there. In that case, whatever is given in the profit and loss account, this itself will be assumed as to be the right depreciation as per section 32. We will assume this itself is the correct depreciation. So these are the two possibilities which you will get in every problem what we solve. So don't go blank, right? So these are the two situations related to depreciation. Situation one, you will get depreciation amount in P&L account also. You will get depreciation amount in adjustment also. So take whichever is as per IT. Situation number two, depreciation is given in P&L account, but nothing is mentioned. In that situation, we will assume whatever is given in the profit and loss account, that itself is as per IT Act, and you don't have to do anything, right? So these are the two uh, situations pertaining to the depreciation. Now let's also discuss some of the other expenses. The fourth one being the preliminary expenses. Now, preliminary expenses are those expenses which primarily is for companies, but for sole proprietor, we might not find a lot of transactions which can come under preliminary expenses, but there are quite a few sometimes it is asked. So that's the reason I want to cover this point also. For company, what are the examples of preliminary expenses? For company, all those expenses which is incurred by a company prior to its incorporation, prior to obtaining certificate of incorporation, it is called as preliminary expenses. But for sole proprietor, there is nothing called incorporation certificate as such, right? And point number two, all those expenses incurred in borrowing funds, right? So that is also treated as preliminary expenses. Discount on issue of shares, discount on issue of debentures, underwriting expenses, uh, survey expenses is also considered as preliminary expenses. So sole proprietor will not issue debentures. Sole proprietor will not issue shares. Sole proprietor incorporation certificate is not there. Only item that will come under preliminary expenses for sole proprietor is survey expenses. Marketing and survey expenses is also considered as preliminary expenses. So even though you are a sole proprietor, you can also take up survey and marketing research, because at the end of the day, any business, small or big, you have to ensure that your customers are satisfied and you're able to deliver value for what you're charging to the customer, for which understanding customer is very important, for which you have to carry out research and other things, right? So preliminary expenses can be market research expenses. So the rule is, in case of preliminary expenses, you cannot charge the entire preliminary expenses at one shot. You have to charge them in 5 installments. That's it. All you have to remember is this, that preliminary expenses are charged in 5 installments. So let's say I am a shopkeeper in Brigade Road and I have done a survey. Are really customers happy coming to my store in Brigade Road? And what kind of a challenges they face while shopping at Brigade Road? I've done a survey to understand why the sales is less, because nobody wants to go to Brigade Road for various reasons. So I've spent 1 lakh rupees on survey. So this will be considered as preliminary expenses. So I can charge this not at one shot, but over a period of 5 years, which means every year I can deduct 20,000 from my P&L account. Not at one shot. Every year I can deduct 20,000. So preliminary expenses, in simple words, is allowed, but in 5 installments. Next, you have a very interesting transaction that will come in most of the problems. Interest on borrowed capital. Interest on borrowed capital. When you're taking a loan, whether it is from a financer or a bank, loan will go to balance sheet because it's a capital receipt. But the interest what you're paying on loan, that's a revenue receipt. So interest you can deduct from your profit and loss account. There is nothing wrong in that. But is it okay to charge interest on your own capital? Let's say I'm a businessman, I've hardly borrowed any money. The entire business is running from my savings. So my entire savings I've invested as my capital. So can I claim interest on my own capital? The answer is, you can see here. I'll just show you the P&L account, what we had gone through. If you see here, this proprietor has charged interest on his own capital. He's saying it's my money and I'm taking interest. How much he has taken? 9,000. So logically speaking, who enjoys this entire profit? Sole proprietor. The entire profit belongs to him. Had he not deducted this 9,000, what would have been the profit? The profit would have been 84,000, which he would have only taken. Then why is he charging 9,000? For a simple reason that instead of paying tax on 84, he wants to pay tax only on 75. so that he can reduce the tax liability. So the income tax department is very smart. They're saying you cannot charge interest for your own capital. Okay, have you taken the capital from somebody else? You have taken loan, you have borrowed money, you're paying interest to an outsider. Go ahead and do it. We will allow the interest on borrowed capital. But if the interest is on your own capital, then not permissible. So therefore, interest on own capital is inadmissible. So that's the point which I wanted to make. Borrowed capital allowed, interest on own capital is not allowed. But let's say there are smart people. There are so many smart people out there. You go to a chartered accountant, he will give you all KD ideas, right? He will give you all wicked ideas. Now he says, okay, if you say interest on my own capital, income tax department will not allow, right? And anyways, it's your own money also, so I have not borrowed anything. So I'll give you an idea as a chartered accountant. What you do is you say that you have borrowed money from your wife and you claim interest to wife. Let's say I've done business, I've started my business with 20 lakh rupees. Okay, this is my investment. But what I'm saying is, if I say this is my own money, if I say I'm paying 10% interest on this to me only, income tax department will not allow. But what if I tell income tax department that this 20 lakhs I've taken from my wife and I'm paying 10% interest to my wife? Will this be allowed now or not? What do you guys think? Now I want to know your response. I have muted all of you, but you can give me your response on the chat box. What do you think? Will this be allowed? There are a lot of smart people who do this. Just tell me whether this is allowed or not. Interest paid to wife, or let's say interest paid to father-in-law, interest paid to mother-in-law, interest paid to dad, mom. Will this be allowed? Because the rule what I'm showing you on the slide says interest on borrowed capital is allowed, but interest on own capital is not allowed. So why not strike a balance like this? So the answer to this question is, as roll number 74 has replied to me saying that yes, it is allowed, but roll number 34 says no, it's not allowed. The answer to this question is interest paid for a loan taken from relative, whether it is wife, son, daughter, anybody is allowed, but there should be a proper agreement. So if let us say you have claimed this, you have said interest paid to wife, you have claimed 1 lakh rupees. In our example, how much is the interest? Uh, in our example, 10% on 20 lakhs comes to 2 lakh rupees. So you have claimed 2 lakh rupees as interest. So you have filed your returns, but unfortunately your return is selected for scrutiny. So I am the income tax officer who is going through your statements, and I see that you have claimed 22 lakh rupees as interest paid to wife. So what I will do here is I will send you a notice saying that give me the agreement of loan which you have entered with your wife. You can borrow money from your wife, but there should be a formal agreement. There should be an agreement stating that wife is giving so much of money to husband. This is the duration to repay. And in case if if the husband is not able to repay, what are the consequences? The way you sign an agreement while taking a loan with an outsider, with a bank, with a financial institution, same kind of formal arrangement you should also have with your wife. Only then I will allow. Otherwise, I will not allow. Second, your wife is getting 2 lakh rupees from you as interest. Is she also paying tax on that 2 lakh rupees income what she has had? That will also be scrutinized, right? But for us, that's not a matter of concern. Our matter of concern was whether interest taken from whether interest paid on loan taken from a relative is allowed as an expense or not. The answer is yes, provided there has to be a formal agreement. In the absence of formal agreement, it will not be allowed. So it's as simple as that. So interest from any relative for that matter is allowed. But what is not allowed, you just remember, interest on your own capital is inadmissible. So you can't claim interest on your own money, which according to me makes a lot of sense, right? So that's our point number 5. We will conclude with point number 6, today's class. Contribution to certain funds for employee welfare. Now, employees are part of business and they're a very important resource in business, whether it's a small shop or whether it is a company as big as Apple. employees play a very important role, right? In a small shop, employee plays an important role by showing his salesmanship, by converting customers into sales. So whatever you pay to employee is considered as a business expense, whether it is a commission, whether it is a salary, whether it is a bonus, whether it is a retirement benefit like gratuity, all these are allowed, right? So certain contribution to employee welfare. So let's say, what do you mean by welfare? Welfare here refers to social security. That means after the employee has retired or left the business organization, he should continue to receive some sort of a benefit, for which the organizations generally give gratuity, pension, provident fund. These are called employee welfare benefits. Income taxes, absolutely this is allowed. Just remember what is not allowed. Instead of remembering which are the welfare funds which are allowed, just remember what is not allowed. So what is not allowed is two things. One, unrecognized provident fund. Second, staff welfare fund. Why do you think income tax would not have allowed these two? The reason is unrecognized provident fund is not approved by Commissioner of Income Tax. It's a private fund which is not under the custody of Government of India. Whereas recognized provident fund, statutory provident fund, public provident fund, all the three are under the custody of Government of India. But this is managed by private. So always, obviously, there can be cheating, fraud, manipulation. So therefore, it is not approved. Second, staff welfare fund. I'm asking all the staff members in my company to contribute 100 rupees every month from their salary. So every month I'm taking 100 rupees, keeping it in bank account. In case some employee falls sick, meets with an accident, hospitalized, the same money I'm giving it for employees. So that's what I'm doing as a businessman. But unfortunately, this is also not allowed because there is a scope that this fund can also be mismanaged. This fund also can be misused by the employer. So therefore, this is also not allowed. So what is not allowed? You remember there are two employee welfare expenses which are expressly disallowed. One is unrecognized provident fund and the other one is staff welfare fund. Now, apart from these two, there is one confusing transaction which I want you guys to remember. It is called staff welfare expense. So don't get confused between staff welfare fund and staff welfare expenses. Staff welfare expenses are allowed. What are staff welfare expenses? Let's say we are having a birthday celebration of all the employees, for which I'm only spending money. I'm only getting the cake and giving to all employees. As an employer, as a shop owner, I celebrate the birthday of my employees. Staff welfare expense. I'm giving mineral water to all my employees. I'm giving beverages, tea and coffee to all my employees. All these are considered as staff welfare expenses. So there's a difference between fund and expense. So don't get confused. Fund is not allowed, but staff welfare expenses allowed. Okay. So without going further, now we'll conclude the class because too much of input sometimes. Again, income tax is a subject that too much will also make it difficult for you guys to remember. So I'll probably wind up the class and